Welcome to This Explainer. Today, we're unpacking a fascinating and honestly kind of hidden corner of the mortgage finance industry. We're going to look through the lens of the SASB Sustainability Accounting Standards to see how everyday mortgage lending practices and the hidden financial incentives driving them can trigger a massive domino effect. As you'll see, loan originator incentive structures and crystal clear customer communication are absolutely crucial. Without them, institutions risk intense regulatory scrutiny and can easily end up holding some incredibly dangerous, highly concentrated risky products. Let's kick things off with a pretty fundamental question. What actually happens when the folks selling mortgages are literally paid to take on more risk? Think about it. When you buy a house, you sit across the desk from a professional who guides you through the process. But what's guiding them? Today, we're going to decode the exact metrics that institutional investors use to figure out if a bank's lending practices are building a solid foundation or just a house of cards. So here is our roadmap for today. 1. Behind the mortgage curtain. 2. The danger of bad incentives. 3. Transparency and customer communication. 4. Measuring the risky products. And finally, 5. The cost of getting caught. All right, Section 1, Behind the Mortgage Curtain. Let's look at who is actually setting up these loans. We're talking about mortgage loan originators. These are your loan officers and brokers, the real front line of the whole operation. While the industry provides the undeniable public good of homeownership, it's entirely driven by individuals arranging credit. But look at the key phrase here, for compensation or monetary gain, right? That is the engine. How you compensate these frontline workers pretty much dictates the health of the entire financial institution.
Moving right into Section 2, the danger of bad incentives.
Take a look at this quote straight from the SASB standards. It absolutely hits the nail on the head. Pay close attention to the word unintentionally. You know, a bank probably isn't waking up deciding to trap its consumers. But if their pay structure rewards volume over quality or high interest rates over affordability, they are unintentionally pushing originators to sell bad, unsuitable loans. It's the exact mechanism that leads to a high concentration of toxic products on a bank's balance sheet.
And just look at the sheer number of ways a loan officer's pay can be tied directly to squeezing more money out of a borrower. According to SASB standard FNMF 278.4, investors need the whole shebang on these pay structures. Are originators getting bonuses just for writing massive loans? Are their commissions tied to locking a customer into a higher interest rate or charging more upfront fees? If an originator gets a bigger check for selling you a more expensive loan, well, that's a massive conflict of interest. It's exactly why transparent disclosure of these payment structures is a totally non-negotiable metric for assessing risk. Which brings us to Section 3. Transparency and customer communication.
Because think about it, how are these highly incentivized products actually explained to the person sitting across the desk? When originators chase commissions by keeping buyers in the dark about primary or add-on products, it sets off a huge chain reaction. The SASB standards make it clear. Transparency is critical. If a firm gives fair, transparent advice, they protect shareholder value. Keep things opaque, and you're not just hurting the borrower, you're actively rolling out the red carpet for regulatory scrutiny and massive reputation damage. Regulators are always hunting for predatory lending, and a lack of transparency is red flag number 1. Okay, Section 4, Measuring the Risky Products. This is where we look at the actual fallout on the balance sheet. So when those dominoes of bad incentives and poor communication start falling, what do you get? A portfolio loaded with risky products. SASB requires firms to measure this stuff because it's a severe threat to long-term stability. We're talking about things like combined fixed and variable rate loans. You know, the ones that look super affordable until the rate resets and the borrower gets massive payment shock. Or loans with prepayment penalties that literally trap distressed borrowers from refinancing. If an investor sees a high concentration of these products, it screams that the firm is prioritizing a quick buck over long-term survival. Let's break down some of the jargon here with one of the wildest products out there, the negative amortization mortgage. Basically, this means the borrower's debt is actually growing every single month instead of shrinking. You make your required monthly payment, sure, but it doesn't even cover the interest charged, so the leftover interest gets slapped right onto your total principal balance. It is incredibly risky, and it's often sold to folks who don't fully understand the mechanics, usually because the originator had a major financial incentive to close that specific deal. To track this exact danger, SASB standard FMMF 278.1 forces companies to put all their cards on the table. Investors don't just want a vague heads up that risky loans exist, they demand to see exactly how many are sitting on the books and what their total loan value is. Think of this table like a financial X-ray of the firm's lending practices. It separates the boring, safe mortgages from the highly volatile, heavily incentivized stuff we've been talking about. Finally, Section 5, the cost of getting caught, the final domino. Because of those risky lending practices, we see this really tragic progression of borrower distress. First, the borrower can't afford the payment, leading to a loan modification where the bank has to change the original terms just to keep the loan alive. If that fails, it's a short sale, the bank takes a haircut on what's owed, and ultimately foreclosure. The borrower defaults, the home is forcefully sold, and the bank takes a massive hit. It's devastating for the homeowner, for sure, but it's also a direct destruction of shareholder value caused by the original bad loan. And once again, investors want the hard numbers. This table right here, straight from the SASB standards, forces the institution to quantify their failures. A high number of modifications, foreclosures, and short sales, that's the ultimate proof that the original lending practices and incentive structures were completely flawed. It's essentially the financial wreckage laid bare, row by row. And let's not forget the legal fallout. This is metric FNMF 27A.3, which tracks the total monetary losses from legal proceedings tied to customer communication or originator pay. We're talking staggering numbers here. Civil judgments, disgorgement, massive regulatory fines, restitution. When a bank incentivizes bad loans and hides the truth from the consumer, regulators are going to step in. And the cost of getting caught? It completely wipes out whatever short-term profits those originators brought in to begin with. So, as we wrap up this explainer, I want to leave you with a thought for the next time you're evaluating a mortgage lender or looking at a bank's stock. Are they truly transparent about how their loan officers are paid to lend to you? Because as we've seen today, those hidden paychecks can trigger a domino effect that ends in foreclosures, massive legal fines, and a totally wrecked institution. Understanding those hidden dynamics, that's how you spot the real risk behind the mortgage curtain. Thanks for diving into the standards with us today.